Free cash flows. The way that we will implement the NPV method is to estimate the incremental free cash flows from a project and then calculate the net present value of those cash flows. And if that's a positive number, then we are better off undertaking that decision. I think we're probably fairly familiar with what a cash flow is, but it's very important to focus on the words incremental and free. An incremental cash flow means an amount of money that the firm is better or worse off as a direct result of a particular decision. We need to work out exactly how many dollars a firm will be better off if it goes ahead with a particular project. Any cash flow that does not change as a result of the decision is not relevant to making the decision. The other important word is the word free. Free cash flows mean cash flows without regard to how a project is financed. And I'll come back to this concept shortly. The way in which we'll make investment decisions is to calculate the net present value of the incremental free cash flows associated with a particular decision. And if that NPV is greater than 0, then going ahead with that decision will increase the value of the firm. Financing decisions, decisions about how to raise the capital needed for the investment decisions, determine the cost of capital, the amount of money we have to pay to providers of capital for the privilege of using their money. That cost of capital is the discount rate that we will use in calculating the NPV of a project. In this topic we will take that as a given. In a later topic on cost of capital, we'll look at how it is calculated. The important thing for us to remember is that the cost of capital reflects the financing costs. The more it costs to raise capital, the higher the cost of capital, and this will impact upon the NPV. But we don't include financing costs as part of the cash flows from a project. As we mentioned earlier, free cash flows are cash flows that are not connected with the financing of a project. We calculate the NPV of the free cash flows to see whether the project is worth undertaking. The higher the financing costs, the higher the cost of capital, which is reflected in the discount rate used to calculate the NPV. So if we included financing costs as cash flows from the project, we would in effect be counting them twice. Once in the cost of capital, and then again as a cash flow associated with the project. A firm is considering replacing an existing machine with a newer model. The maintenance cost of the existing machine is $5,000 per year. The maintenance cost of the new machine would be $3,500 per year. In terms of the maintenance cost, what is the incremental free cash flow of the decision to replace the existing machine? The answer is positive $1,500. If we make this decision to replace the machine, then in terms of maintenance costs, we are better off by $1,500. So that's a positive incremental cash flow. Which of the following costs associated with this project, replacing an old machine with a newer model, is not an incremental free cash flow? The interest on a loan taken out to buy the new machine, the purchase price of the new machine, or the new machine's installation costs? The answer is A, the interest on the loan. This is a financing cost, and financing costs are not included in the free cash flows of a project when we're working out its net present value. On this slide I will summarize the incremental free cash flows associated with a typical project, and then in the remaining modules in this topic we'll go through all of these cash flows one by one. There are some cash flows associated with the commencement of the project. In terms of the timing of these cash flows, we say that they occur immediately or at time period 0. Often we need to purchase equipment. There may be other initial development costs to get the project up and running, and often there is an increase in net working capital. Then over the life of the project, there are ongoing cash flows that occur every year. We have incremental revenue, incremental costs, we have taxes associated with the revenue, and a tax shield from the incremental costs. A tax shield means that we pay less tax than we otherwise would because of a particular decision. And then we also have a depreciation tax shield. We pay less tax as a result of depreciation. And then terminal cash flows occur at the end of a project. There may be a salvage value. We may be able to sell the equipment that we've used in the project for a positive amount of money. There may be a tax on the profit or loss from the sale of the asset. There may be other costs to shut down the project, such as restoring the environment to what it was before the project began. And then if we've had an increase in net working capital, then we will recover that net working capital at the end of the project. The nature of some of these cash flows may be clear to you, others you might not be too sure about, but we'll go through them one by one throughout the remainder of this topic.